Good day, everyone, and welcome to this special 8th edition of the Asian Monetary Policy Forum. The MAS is very pleased to partner with the BIS on this important and timely topic of macro-financial stability policy in a globalized world. Over the next few days, there will be a rich program of country experiences coupled with thematic presentations that bring together the insights of central banks and academics. Now, the underlying motivation for the topic of this forum could probably be traced to at least 3 coincident realities confronting policymakers in both advanced economies and the emerging market economies. First, it appears that the inadequacies of the post-Bretton Woods international monetary system have caught up to us. The uncoordinated system of equilibrating exchange rates and external balances has struggled to accommodate the very high and growing cross-border capital mobility. Second, real and especially financial shocks to open economies have become more frequent and severe. These have necessitated more intense domestic price and activity adjustments and have induced an acceleration of underlying resource reallocation with the attendant stability implications. And third, there has been an evident reduction in the effectiveness of the interest rate instrument as an aggregate management tool. This in turn can be attributed to a nominal factor, namely the flattening of the Phillips curve, and a real one in the form of the secular decline in the neutral rate of interest. So the time is ripe indeed for an update of the research on policy stability frameworks to better reflect these emerging factors. This objective is the crux of this forum and the subsequent conference volume, which will bring together the richness of experiences of countries represented here with state-of-art theory and empirics. I'm pleased that we have an illustrious slate of speakers for this opening session on day 1. Managing Director MAS Ravi Menon and BIS General Manager Augustine Carstens will deliver opening remarks, and we are very grateful for their strong support for this project. Both are well known and profoundly influential in the international central bank circuit and have been enthusiastic advocates of the integrated policy framework agenda. They certainly emphasize the importance of informed policy making on robust analytical foundations. Professor Anil Kashyap, a pioneer in financial stability research and policy, will deliver this year's keynote speech before the first overview session helmed by the formidable BIS trio of Boryo, Shin, and Shim. Thank you. So now may I please invite Managing Director Ravi Menon to deliver your remarks, please.
Thank you, Edward. Mr. Augustine Carstens, General Manager, Bank for International Settlements. Ladies and gentlemen, good afternoon, and welcome to this year's special edition of the Asian Monetary Policy Forum, featuring the MAS-BIS conference on macro-financial stability. The origins of this conference go back to a conversation that Augustine and I had about 18 months ago on the need to crystallize a coherent policy framework for macro-financial stability. For the 3 decades preceding the global financial crisis, the traditional inflation targeting framework for monetary policy has served most economies well, delivering price stability as a basis for sustained economic growth. That framework is now coming under strain. Emerging market economies, EMEs, faced with large and volatile international capital flows, have had to resort to a variety of policy tools besides traditional monetary policy to achieve both macroeconomic and macro-financial stability. The advanced economies faced with rising leverage and growth in financial assets against the backdrop of extremely low interest rates are also looking at macro-prudential measures as a basis for promoting financial stability. Practice has moved ahead of theory. In the absence of a conceptual framework, EME central banks facing large capital flows have had to experiment with the tools at their disposal, such as foreign exchange intervention, macro-prudential policies, and capital flow management measures. There is now a rich body of policy experiences, especially in emerging Asia, crying for a theoretical framework. We need a framework that provides coherence, not only across these various policy tools, but also with traditional monetary and fiscal policies. There is an active research agenda at the BIS on such an integrated policy framework. As a practitioner of some of these policies, MAS is delighted and honored to organize this conference together with the BIS. When central bankers from advanced economies meet, they discuss quantitative easing and R star, the natural rate of interest. When EME central bankers meet, they talk about capital flows. What's the big deal with capital flows? Well, first, capital flows to EMEs have become quite large. Annual gross portfolio inflows have grown to an average 1.3% of EME's GDP in the 8 years following the global financial crisis, compared to an average 0.7% during the 8 years prior. A key driver of the surge in cross-border capital flows has been the prolonged period of near zero interest rates and highly expansionary monetary policies in the advanced economies. There is empirical evidence that quantitative easing policies in the United States have made capital flows to EMEs more pro-cyclical. Second, capital flows have become more volatile. Volatility almost doubled in the 3 years post-global financial crisis compared to the 3 years preceding the crisis. And volatility has since remained elevated. Third, large and volatile capital flows can create some serious trouble for EMEs. What flows in can flow out as easily, and such reversals can be disruptive for EME financial markets, which are typically not deep enough to smoothly intermediate the flows. Capital flows can induce exchange rate fluctuations that are disconnected from macroeconomic fundamentals. There is growing empirical evidence that capital flows to emerging market economies have grown in importance as a driver of their exchange rate movements. In particular, capital flows can cause cyclical deviations to exchange rates beyond movements driven by the current account of the balance of payments. And in the face of large and volatile capital flows, a freely floating exchange rate can become a shock amplifier rather than a shock absorber. Capital flows can trigger financial stresses or exacerbate domestic financial vulnerabilities. Strong capital inflows risk fueling domestic credit and asset bubbles, heightening risks to macro financial stability in EMEs. A recent MAS study found that a 1% appreciation of the US dollar is associated with net capital outflows of 0.3% of the GDP for EMEs in the following quarter. Fourth, large and volatile capital flows are here to stay. Aging populations and slower productivity growth in the advanced economies suggest that the natural rate of interest, R star, is likely to remain low, making the search for yield and resultant capital flows persistent rather than episodic. In setting monetary policies, should advanced economies take into account the spillover effects on EMEs through capital flows? Well, it is neither feasible nor desirable for advanced economies' monetary policies to be constrained by considerations of the cross-border spillovers they generate. Advanced economy central banks have their own domestic macro stability goals that they need to meet and cannot be expected to suboptimize their policy outcomes. Moreover, accommodative monetary policies in the advanced economies have generated positive spillovers to EMEs through strengthening export demand and enabling conducive financing conditions. At the same time, it must be recognized that monetary policy latitude in EMEs is to some extent compromised by large capital flows. Empirical studies have found that EME's monetary policy responds to movements in US interest rates and exchange rates besides their own domestic macroeconomic conditions. EMEs should therefore have the flexibility to use the policy tools at their disposal to protect their domestic economies from risks arising from large capital flows. What are some of the questions that an integrated policy framework should seek to address? The existence of different policy objectives and multiple sources of disequilibria necessitates the use of a range of policy instruments. These can be grouped under three broad categories: foreign exchange interventions, macro-prudential measures, and capital flow management measures. Determining which tool is appropriate has been a matter of careful judgment, depending on policymakers' objectives, country circumstances, available policy space, and the nature of the shock. Policymakers have typically assigned interest rates as an instrument for price stability, macroprudential measures for financial stability, foreign exchange intervention for exchange rate stability, and capital flow management measures for directly curbing capital inflows and outflows. However, the reality is more complex as these policies interact and have overlapping effects. For instance, macroprudential measures working through the credit channel can have a dampening effect on aggregate demand and influence the attainment of monetary policy objectives. In other cases, some countries use capital flow management measures to mitigate capital outflows to stabilize exchange rates if foreign exchange intervention proves insufficient. An integrated policy framework needs to provide greater clarity on these interactions. We need a deeper understanding of how these instruments can complement, substitute, or conflict with one another. For example, we need to better understand the interactions between monetary policy and macroprudential regulation in achieving both price and financial stability. Our view, or one view, is that monetary and macroprudential policies are largely complementary and hence should be used together for better results. For instance, an IMF study found that tighter macroprudential measures to address financial stability risks are associated with more counter-cyclical monetary policy responses to macroeconomic shocks. An alternative perspective is that monetary policy can be used to achieve both price and financial stability. By setting the price of leverage and influencing risk-taking, monetary policy can lean against the buildup of excessive credit and financial imbalances, thus mitigating financial stability risks. However, and this is a point I've made elsewhere, monetary policy is too blunt an instrument for addressing specific risks to financial stability. And it can sometimes cause collateral damage to the rest of the economy if it tries to do so. An integrated policy framework could perhaps shed light on the circumstances under which monetary policy could also serve financial stability objectives, and whether there are benefits to jointly calibrating monetary policy and macroprudential policy, as well as how this calibration should be done. The BIS and IMF have both been undertaking research on these issues. Central bankers have at the same time gained considerable experience in employing an eclectic mix of policy instruments with varying degrees of success. There is merit in bringing these practical experiences to bear in formulating an integrated policy framework. Developing effective policy instruments and using them in a coherent fashion will enhance macroeconomic and macrofinancial stability. It will help to make financial globalization safer, especially for EMEs, at a time when there are growing risks of fragmentation in international economic relationships. Your task is therefore vital. I wish you a fruitful conference ahead. Thank you.
Thank you very much, MD, for that insightful and clear exposition. And now, by the marvels of cross-border digital transmission, can I please invite General Manager Augustin Carstens in Basel to share your perspectives, please?
Good morning, good afternoon, good evening to all of you around the globe. It's a real pleasure for me to share these opening remarks with Ravi Menon and thank him for a very decisive collaboration in making this conference on macrofinancial stability in a globalized world a reality. Precisely as Ravi mentioned, this conference was originated out of a dialogue that both Ravi and myself had like 18 months ago, precisely when in the BIS we were trying to establish our new medium-term strategy, in which a key aspect is to say, how can we bring more of Basel to Asia, and how can we bring more of Asia to Basel? With the tremendous clarity that Ravi just illustrated us, the huge challenges that are present in terms of policy making in small open economies, in emerging markets, in this globalized world. He expressed then his desire to embark in a concerted effort, I would say, joint effort to produce a collection of papers that would serve as a standard authoritative reference on macrofinancial stability policies, based primarily on the experience of policymakers on the front line. So precisely the main purpose of this conference is to showcase and debate such papers. Certainly this represents a great opportunity to take stock of how challenges have evolved in the pursuit of macro stability in a globalized world during the last years, obviously trying to identify the best policy responses to deal with such challenges. But let me take a different tack than Ravi took in his opening remarks. He made a tremendous tour de force in explaining where we are and where the challenges are. So I would like now to make a comment more on the process that we policymakers, academicians, and thinkers are following as we adjust our policy tools to reality. And I think there we should reflect further. I think this tremendous impulse that Ravi gave to this conference, and more than the conference itself, the process that he unleashed to try to be on top of the curve, I think is something that we have to learn from and pursue it further. So let me start by saying that the challenges and circumstances evolve through time. We need to learn from the past to prepare better for the future. So as Ravi has said, macrofinancial stability theory has lagged behind practice. But I would say practice has tended also to lag behind actual developments. Thus we need as policymakers to break the cycle and to do our best to head off the new challenges before they materialize. I would say that through history, if you do a backward-looking exercise, of course, you can identify a few major events or happenings that represent game changers in the way macro financial stability evolves into the future. So let me take this abbreviated sweep of history, trying to illustrate a few of these events that if we had realized in time, we probably would have done much better. So this would illustrate how we have the habit of catching up from behind, rising to the occasion, but rarely positioning us ahead of the curve. So in the 70s, in the context of the Mundell-Fleming framework characterized by fixed exchange rate regimes under the Bretton Woods agreements, the key challenge was how to recycle petrodollars, big blinking light petrodollars. The result was overextended banks lending to overextended governments in emerging markets, insufficient discipline in fiscal and monetary policy in the face of massive capital inflows led to balance of payment crisis and unsustainability of exchange rate regimes. International banks' health was seriously eroded. The model blew up, ended in the 80s with the debt crisis and the urgent need to mind the capitalization of banks. Again, capital of banks started showing up. Precisely in a task that the BIS started to show very important leadership. So after a lost decade in many emerging markets and sufficient time to recapitalize the banks, in the late 80s, massive sovereign debt restructuring took place under the auspices of the Brady Plan. This was made possible, obviously, by a major international effort where the IMF and other IFIs took place, governments took place, but also it was made possible by major stabilization efforts by emerging markets following the so-called Washington Consensus, which basically implies the pursuit of fiscal and monetary discipline, opening up the economies, still in most of the cases with relatively controlled exchange rate regimes. The most significant development for global financial stabilization purposes was, though, the securitization of sovereign debts into marketable securities. We now move into a world where that's fully forced into, it's fully dependable on capital markets. And I think at that time, we really didn't understand fully the implications of this. International banks took the back seat, giving way to capital flows in the form of securities. So this opening up of capital accounts and massive development of capital markets happened in the late 80s and early 90s, still with pretty much fixed exchange rate regimes. This is an awkward combination that now we're not supposed to say that didn't end up well. At the time, there was also insufficient recognition of the importance of banking regulation. Weak banks in emerging markets were exposed themselves to massive currency and credit risk. And needless to say, all of this came crashing down with the tequila crisis, representing the first of a sequence of currency cum banking crisis in the 90s. So here again, a few issues are important. Major opening to security markets, opening capital accounts, and not having prepared banking systems and appropriate exchange rate regimes. In late 1990s and in the 2000s, there was a massive adoption of inflation targeting with flexible exchange rates. There was also a very important process of institutionalization of central banks, with, I would say at that time, an unfortunate combination of massive regulation in capital markets. Even though banking regulation and the Basel standards gained greater prominence. There was a big push for development of local bond markets in emerging markets, together with the creation of derivative markets in emerging markets that would facilitate hedging, allowing greater scope for global investment flows into local currency bonds. Here again, we need to embrace modernity, we need to open our markets, we need to develop hedging instruments, and let's go all for it. But again, we probably didn't do it with all the safeguards in place. Some foresight was anticipated here, and in this time there were important developments in terms of support facilities like the IMF CCL, or the creation of or development of more regional support facilities like the Chiang Mai initiative. We had a few good years, especially in emerging markets, in particular before the 2008 global financial crisis. The GFC hit, which was a major crisis in advanced economies, but in emerging markets were in much better shape. This shows that we have learned through the process. We did our homework. I would say this gives credit to the fact that we can adapt, and in a way we can have sturdy market conditions. But advanced economies, monetary easing, and asset purchase programs set in motion a new wave of search for yield in securities markets as major theme affecting emerging markets. So here is again a major issue happening. Local currency government bond markets came of age and increased hugely after the global financial crisis. These markets have played a central role since then, as, for example, was illustrated at the time of the taper tantrum. To deal precisely with movements and interruptions associated with massive participation of foreign investors in global bond markets, induced at the time of the taper tantrum the importance of a very important, significant foreign exchange intervention, both in the spot and in the forward markets. The application of capital flow management measures, being, I would say, the first time where these two instruments were sort of sanctified by the orthodoxy in our profession, and now they play a very important role in the integrated framework. At the same time, there was a furthering of the framework for macro-prudential policy, and I would say that the use of these instruments came hand in hand both in advanced economies and emerging markets. Now, we have had since last year the COVID shock, and I would say the COVID shock is a glimpse into the future. And I think we need to take note of this. The initial shock was mitigated by massive loosening of U.S. monetary policy. But in so far, so good, no? But in terms of issues, what can we say? Well, on the positive side is that banks are stronger, and many macro frameworks, macro stability frameworks, also played quite well. But some new themes have been appearing, and I think here's where we need to pay attention. What are these themes? Let me point at least four. In the context of very accommodating global financial conditions that at some point will change, and this is a major underlying issue. Themes, non-bank financial intermediation, that is broadly unregulated. Massive hidden leverage in capital markets. An unresolved issue of dollar funding around the world. And the perpetuation of search for yield. And now under the further representation of what we have been calling in the BIS original sin redux, which basically mean that many countries have been able to issue debt in their own currency that is bought by foreign investors, and now the exchange risk is transferred to foreign investors, which introduces a whole very complex dynamics that we still are dealing with it. So far, so far I think that our framework has been evolving quite well. It has been sturdy, it has showed resilience in the face of both the GFC and I would say COVID. But the real question, are we prepared for these new issues that at some point can become game changers? And here I would say that we need to really think carefully if our models are fit for purpose. And certainly I'm of the opinion that we need to do more work in this line. And I think this echoes pretty much, or expressed in a different way, what Ravi mentioned in his introductory remarks. In particular, I think we need a conceptual framework that captures how these four themes identified above, non-bank financial intermediation, leverage, dollar funding, original sin redux, interacts with fluctuations in global financial conditions. Concretely, the most pressing need is a theory that shows how global financial conditions, probably as proxied by the broad dollar index, affects risk-taking and hence portfolio flows into emerging markets, even in the absence of currency mismatches on the part of the borrower. The focus, I would say, should be on the risk-taking of the global investors. How dollar fluctuations affect risk-taking constraints. When they enter an emerging market local currency bond market unhedged, why a broader-based appreciation of emerging market exchange rates against the dollars loosens risk constraints of investors, leading to portfolio inflows. Once we understand this better, we should look on figuring out the optimal policy response, both at the national and international level. And by the way, the 4 points I addressed before is not just an emerging market problem. Dollar funding is a key issue also for advanced economies. The biggest forex bases are for yen, Swiss franc, and euro. Non-bank financial intermediation are very important everywhere. Leverage was key during the more drastic period of volatility during the COVID crisis. The advanced economies emerging market demarcation is getting blurred. And in this respect, we also need to understand better. This is another, I would say, major emblematic developments in markets that we need to tackle and to try to be ahead of the curve. So I hope that the discussion we are about to have in this conference will shed light on how to tackle the formidable challenges we will face in a not so distant future. We should feel relatively comfortable with what we have been building up in the last decades, but I would say that we still need to have we need to strive to have a healthy periodic debates that will help policymakers to have a better chance to be ahead of the curve. So thank you very much for giving me the opportunity to share these thoughts with you. And I'm sure that this conference will be a huge success, and we shed some lights on the issues that both Ravi and myself have identified. So thank you very much.
Thank you very much, General Manager. In just 30 minutes, both yourself and Managing Director Ravi have laid down the gauntlet for this year's forum by identifying the various aspects of the research macrofinancial agenda and astutely conveying some of your positionings on policy. Let's move on now to the keynote speech. Unfortunately, IT solutions cannot transcend time differences, at least in real time. So we'll be watching this year's keynote address through a pre-recording. But first, allow me to introduce our keynote speaker, Professor Anil Kashyap. He's the Stevens Distinguished Service Professor of Economics and Finance at the University of Chicago Booth School of Business, and is a member of the Bank of England's Financial Policy Committee. Now, over his career, Professor Kashyap has made it a habit of breaking new ground in furthering our understanding of complex economic and financial phenomena. Some of us will know his work in macroeconomics, among them his thesis research on menu costs, as well as his studies into the bank lending channel of monetary policy. Others would highlight his impressive contributions to financial economics. Professor Kashyap has played a prominent role as a proponent of amendments to financial regulation after the GFC, including the requirement that banks should file living wills and then they should consider issuing contingent convertible securities or COCOs that could be used towards capital requirements. As the repercussions of COVID-19 and the urgency of shifting to a greener economy culminate in a major reallocation shock, the problem of optimal corporate restructuring has never been so important, and governments often find themselves torn between preserving jobs in the old economy and creating space for the new economy to expand. Professor Kashyap has already thought about those trade-offs. When Japan's economic growth stalled after its financial crisis in the 1990s, Professor Kashyap, along with his co-authors, demonstrated that the presence of zombie firms kept afloat by weak banks discourages the entry and expansion of healthy and more productive firms. So his AER 2008 paper has been heavily reread during this crisis. I'm now pleased to invite Professor Kashyap to deliver the keynote address for this year's special edition of the AMPF.
Thank you, Edward, for that kind introduction. I've been a fan of this conference since its founding, but it always falls during the quarter when I'm teaching, so I've never been able to attend in person. And that makes it an even bigger honor to be able to give the virtual keynote this year. Before I start, I want to say I'm speaking in my personal capacity and not as a member of the Financial Policy Committee of the Bank of England. And after you hear what I have to say, you'll realize why I want to be clear about that. So here goes, and in the interest of time, these remarks are slightly abbreviated. You'll find the full version on the conference website. Okay, there are lots of references regarding the risk to financial stability as emanating from reckless gambles some people and institutions are willing to take without worrying about the consequences for others. Las Vegas is often referred to as the gambling capital of the world, and its iconic marketing slogan encourages people to come and gamble and have a good time. And the saying goes, what happens in Vegas stays in Vegas. The theme of my presentation is that for financial stability purposes, the analogy with gambling breaks down when it comes to regulation. Instead, because of the interconnected nature of the global financial system in the regulatory domain, I want to argue that what happens in Vegas doesn't stay there. In particular, regulatory loopholes, whether in one jurisdiction or just risks that are unattended to in one place, tend to spread beyond their point of origin. I'm going to split my talk into two parts. I'll start by going through 4 examples that span a variety of financial stability risks. They're all drawn from recent experience, so they exist despite the many helpful reforms that followed the 2008 GFC. I'm hoping the examples will serve 2 purposes. The first is just to shine some light on some problems that are in plain sight and are yet to be addressed. The second is to demonstrate these problems are so pervasive as to be indicative of a process problem within the current regulatory architecture. Unfortunately, as often is the case, it's easier to identify the problems than to solve them. Thus, while I'll close with some recommendations, I'm under no illusion that my suggestions will completely address these problems. At best, maybe they'll help to kick off a conversation that could generate some momentum for a larger rethink of the next round of required steps in regulation. All right, so let me switch slides and come with my first example, which is the widely studied market turmoil in March of 2020. Now, I'm sure this episode is familiar to almost everybody that's watching this, so I'm not going to dwell on the details of what happened. though I do want to call your attention to two recent analyses, one by John Hall and another by Annette Bissing-Jorgensen, that helped me better appreciate some aspects of this episode. So if you haven't seen those papers, please do. For the purposes of today, I will just stipulate that there were a variety of factors that contributed to a surge in selling of U.S. Treasury securities in the middle of last year. That pressure resulted in a sharp rise in Treasury yields. The spike came as equity prices were plunging and measures of volatility were surging. That's highly unusual that you get that constellation of things. Critically, the dislocation in Treasury prices spread to other government bond markets around the world, and the spillovers were material. The Treasury market was stabilized when the Federal Reserve began buying Treasury securities in unprecedented amounts, starting on the 19th of March, when it purchased $70 billion in one day. The Fed continued at that pace until the end of the month. And I included the figure you see here because I doubt most members of the public or Congress realize that the Fed bought more Treasury securities as part of its market stabilization efforts in the first and second quarters of 2020 than it did in its 3 rounds of quantitative easing after the GFC. Just think about that. The next slide reproduces some calculations from the paper listed below by Daryl Duffy. Daryl's been warning about the dangers of relying on dealers to intermediate for this market for some time. So this risk did not just appear out of nowhere. For instance, you can go back and find a paper that he wrote in 2018 that shares these same concerns. It now seems that there's an emerging consensus that many central banks may need to set up some type of standing facility to deal with government securities market turmoil of the sort that we saw in March 2020. And I was glad to see that the FOMC in its last meeting spent some time discussing this. The design of these facilities will be up to the individual central banks, shaped to fit particular market characteristics and legal guideposts. Clearly, there's a public good aspect for the global financial system to make sure that these markets are fit for purpose. And the U.S. authorities have strong incentives to improve the functioning of the U.S. Treasury market. What's less clear to me, though, is whether whatever forms will emerge, that the U.S. will fully internalize the concerns that other countries might have about the reach of these measures. If one is set up, access to the facility would presumably be determined by the Federal Reserve. It's hard to know how access decisions will be made. We do know that some countries in the world would have liked to have had access to swap lines that have not been able to secure them. And I'm not suggesting that the Fed has an obligation to offer access to its facilities or swap lines to anyone who wants one. I'm just not sure how much transparency there will be around these decisions and the extent to which domestic political concerns will be involved in the way that the facility is organized. In particular, will Congress judge that this is purely a technical exercise that can be left to the Fed and other central banks? Or will they have views on how they should be structured? Perhaps my concerns will go unwarranted or prove unwarranted, but I think this case exemplifies how unilateral decisions in one country can have important stability implications for other countries. In the regulatory domain, what happens in Vegas doesn't stay in Vegas. Okay, so the next slide takes me to our second example, the failure of Archigos capital management. Again, I'm sure most of you know about that, here we had a family office that reportedly had assets of around $10 billion, and yet, according to the Financial Times, generated losses on the same order of magnitude for its prime brokers. There are 3 things about this saga that I find striking. First, Bill Wang, the owner of Archigos, had been banned from trading in Hong Kong for 4 years and had paid a fine to the SEC for insider trading. So how was he able to establish prime brokerage relationships with multiple globally systemically important banks? It's all the more puzzling because, according to the FT, Credit Suisse made only $17.5 million in fees in the year prior to the firm's collapse. So my first question is, what should we conclude in someone with this kind of record, who wasn't particularly profitable as a client, be able to continue to gain access to so much funding from so many different large institutions? The second startling thing about this case is that once the trouble at Archigos arrived, many of the exposed banks caucused about what to do, and yet they reached very different decisions. Goldman Sachs and possibly others managed to untangle themselves while taking little or no losses. Well, as you can see from the slide, many others did not. I'd love to know more about the margining practices at the various firms that were doing business with Archigos, and more generally to find out why the responses were so different. And the third thing that seems relevant here is that most of the brokers that were left with large losses were headquartered outside of the United States, where Archigos was based. One wonders what the supervisors in the various countries knew about their bank's exposure to Archigos. Maybe it's just a coincidence that the foreign banks were the ones that were most exposed. Perhaps the same forces that make these large, complex organizations so difficult to manage also create special challenges for home supervisors trying to fully monitor the activities of their banks overseas. Okay, the third example is shown on the next slide, which relates to the large buildup of corporate debt that's been ongoing, and in particular, the surge in leverage lending that's been underway for some time. Just to remind you, the Fed, the OCC, and the FDIC were sufficiently concerned about this that in 2013, they issued guidance to banks, cautioning against originating loans that would be larger than 4 times the borrower's earnings before interest, taxes, and depreciation. At the same time, they noted the growth in the sector was worrisome. In 2017, unfortunately, the Government Accountability Office concluded that this guidance amounted to a regulatory rule and should have been subject to congressional review. That decision meant that the agencies should have had to start the process over again to get the guidance to be legal, and essentially that ended the guidance. However, the loans didn't stop going out, and they continued at a brisk pace, and they continued to be flagged as financial stability concerns, for instance, by both the Bank of England and the Federal Reserve in their respective financial stability reports. Now, despite all this attention, there's no commonly accepted definition of what constitutes a leveraged loan, much like there was no single definition of what a subprime loan was before the GFC. So in the 2 financial stability reports issued by the Bank of England and the Fed in November of 2018, both were pointing to concerns about this market, and yet they differed in their estimates of the size of the market by nearly a factor of 2. The Fed cited the outstanding stock as $992 billion, and the FPC estimated to be closer to $1.8 trillion. Now, subsequently, it seems most estimates have converged to the higher figure. But what really worries me is at a time when many observers were focusing on exactly this market, we were unsure about whether it was closer to a $1 or $2 trillion risk. As the old joke goes, pretty soon we'll be talking about real money. This is just one example of many where we need more data. For example, we also have highly incomplete information about who holds this debt, which, if there were a wave of downgrades, could become important. The example highlights a problem that featured prominently during the global financial crisis. Once activity shifts away from the banking system, our ability to track it deteriorates. And I think it'll be sad if some part of the shadow banking system were to be at the center of the next crisis, and the authorities have to explain to the public and Congress and legislatures everywhere that part of the reason is that we didn't have a proper measurement system in place. Now, my last example, which is on the next slide, relates to bank regulation. And while progress in shoring up bank regulation after the GFC has been substantial, there's still some issues that exist in the current regime. A casual observer might think that capital regulation for banks is pretty thoroughly worked out, and that there would be no glaring loopholes about what banks can do in terms of establishing that they have sufficient loss-absorbing capital. So I found it pretty surprising that software assets can potentially be counted as capital. Apparently, this is possible because intangible assets are supposed to be deducted from capital, and that makes sense. But the definition of intangible capital depends on accounting rules, and these accounting rules differ between the US and elsewhere. In the US, some software assets can be deemed to be tangible assets, and so they don't need to be removed from capital. In Europe, this is not the case. So nonetheless, after the US opted not to subtract the capital, the software assets from capital in the US, the EU authorities decided to follow suit. Now, the EU decision is not compliant with the Basel rule. The Basel rules say you can only have this kind of discretion if it happens to be consistent with accounting rules. So if you think I misspoke, let me say this again. European banks are now allowed to count some investment software as capital, and this is contrary to the Basel rules. Now, as you would expect, when other regulators have tried to verify that somehow the recovery value of software for a firm that's in trouble could be a source of loss absorbency, they find no evidence to support that view. This ruling, this was made in December of last year. As far as I can tell, the rules haven't been around long enough for any banks to really exploit them. But it would be tragic if a bank were able to launch a new risky business in some other jurisdiction on the back of having its capital supported by these kinds of assets, and then that business were to blow up. Another remarkable thing to me is that the EU also has this concept of maximum harmonization. And that rule says that member states are forbidden from modifying new regulations, even if the modification was to make the rule more stringent, for instance, by requiring higher capital levels. When I first joined the FPC, I had to have this explained to me multiple times because I couldn't see how this was a good idea. It appears to just be intended to prevent a dangerous race to the top. Now, hopefully you've seen across these four examples that despite all the progress we've made since the GFC, there's still a lot of unfinished work to go, to do. And so let me close by offering a few ideas about how to proceed. And I'm going to give you 4 recommendations that I think would be somewhat stability enhancing. So on the next slide comes my first recommendation, probably my most important. It would be desirable for all advanced economies to create, or if they have already created, to empower existing financial stability committees. As the quote there from Nellie Lang and Rochelle Edge says, when they looked at how the stability committees have been set up are functioning, they said the evidence suggests that countries are placing relatively low weight on the ability of policy institutions to take action and a high weight on political economy considerations in developing their financial stability governance structures. So this isn't going to be easy. It's probably going to require opening up dialogues with legislatures, but I think it's worth it. This kind of change would help in 2 ways. First, it would create entities that at least stand a chance at keeping up with the inevitable evolution of the financial system. And second, it might mean some of the specific risks that I've identified could be remedied. For instance, if there really was a financial stability committee that was looking at software assets, I can't believe that such a committee would permit software to count as loss absorbing capital. And if a complete overhaul is infeasible in some cases, it might be helpful for an international organization to produce an assessment of what powers existing authorities have but are being unused. I think it would be really powerful to compile this information in a single report that compares jurisdictions and creates a common scorecard. Having the knowledge to do this would require a lot of institutional information to compare countries all around the world. And I just don't think academics would have such information. So if this is going to happen, it's going to require the work of a large team and probably one that will involve an official organization. My conjecture from the case that I know the best, the US, is that even without any major legislation, there are some steps that could have been taken already that would be useful and would help with some of the gaps and holes in regulations. And having a big comparative document, I think, would put pressure on everybody to reach a little, to do more. Now, the second suggestion on the next slide is to accelerate reforms to enhance data collection authority, at least in all the jurisdictions that have globally systemic financial institutions. The Office of Financial Research in the US, for instance, I think could be reoriented to be much more active and focused on eliminating data gaps. The problem with identifying data on holdings of leveraged loans is just one way in which ownership information is frustratingly incomplete. For example, we almost know nothing about corporate bond ownership around the world. And those holdings are scattered across the globe. And absent a high degree of cooperation, we're not going to get this information. So we just need better data collection in many countries, and creating something similar to the reoriented OFR that I just described in all these countries would be valuable. And as a first step, it'd be great to create a template that covers how to organize the data that we already know we want to get, and to begin collecting that data in different jurisdictions on a consistent basis. Okay, my third example in the next slide is another information request that I'd like to make, and that's for a forensic investigation of Archigos. Again, there's no obvious institution that has both access to the relevant information and a mandate to do this kind of thing, and I think that's a problem. I mean, maybe this could be undertaken via collaboration of various financial stability committees, or maybe it could be done as a special project by the IMF with the cooperation of the regulators. But we need to do this. Absent some sort of a follow-up investigation like this, we're never going to be able to figure out exactly what happened. And whether or not Archigos was the canary in the coal mine or just a freak example by chance is something we really want to figure out. So we need to get a comprehensive picture of what they held and what they were borrowing from the different entities and why they reached such different judgments. Now, finally, and here's my last slide, in terms of the Treasury market, I hope the U.S. is going to set up some sort of facility. The minutes from the FOMC that were just released make this seem pretty promising. One of the proposals that intrigues me is the possibility of having the Federal Reserve become a member of the Fixed Income Clearing Corporation, FIC. Now, FIC is the clearing entity operated by the Depository Trust and Clearing Corporation. And if the Fed were to do this, it would have a single counterparty, the FIC, which is AAA rated. But by entering the FIC, it could potentially engage in repurchase agreements or cash market trades of Treasury securities with a much wider range of counterparties that it can currently interact with. The Fed could control the pricing and the terms of the repo in which it participates. So it could set different rules for different institutions, for instance, depending on how tightly regulated they are or supervised they are. Now, the full feasibility of this needs to be studied, but this could be a quick way to stand up a facility that builds on existing infrastructure and still gets the Fed into a way to interact with many, many more counterparties. All right, well, thank you for the opportunity to share these thoughts, and I look forward to your questions.
Thank you very much, Professor, for that very impactful presentation. What struck me was that the punchline from your speech, what happens in Vegas does not stay in Vegas, quite appropriately captures your central thesis that isolated financial risk can very possibly spread beyond their points of origin. And I guess the second takeaway for me is the point about regulators, that the challenge that regulators face, and you seem to have usefully framed the debate as a race between new forms of finance and financial regulation. So if I could start with the first question, and that's really related to a point that you made in your speech about once activity shifts away from the core banking system, our ability to track it dissipates or deteriorates. And then we know that many new players have entered the scene since the GFC. So you have the big tech firms and other sort of specialized financial service companies. Yet we don't have a systematic sort of harmonized way to regulate and govern these entities. So my question is how should authorities, do you have some guidance as to how authorities should approach these potential new elephants in the room? Specifically, what do you envisage as core elements of a framework that regulators should have in mind if they are to proactively anticipate the risk as the financial system itself adapts? Thank you.
Let me try to give an example from the US case to be a little bit more specific. So imagine we had a slightly different version of the Financial Stability Oversight Council that was filing each year a report that in it reached a judgment that said, here are the three biggest risks that we see. And they would go before Congress and say, here are the risks that we've identified. There's three of them. Two of them are so serious that we need your help. We need some sort of legislation. One of them we think is big, but it's not yet to the level that we need to do something about it. That'd be the first step. I would like in that reporting that the FSOC would be required to do a look back where for the last 3 years, they would identify everything that's changed in the financial system by a substantial amount. Because one of the problems that you pointed to is often these issues build up over time. And in no particular year is there some sort of abrupt shift that makes you think, okay, we have to do something about this now. But if you stood back and said, well, 3 years ago, this sector or this financing vehicle or this kind of institution was tiny, and now look how big it is, you'd immediately say, this probably is something that merits attention. So I think there should be mandatory look backs that say, we're going to scan the entire financial system. We're going to look at things that are growing quickly. And if it's a problem, we're going to identify it. And if we identify it, we're going to propose something to do about it, either that we can do already using our existing powers, or if we need new authority or new monitoring, we'll go that route. And if you combine that with an OFR that was reorganized the way I described, where its primary job was now to try to get data and fill in data and make sure that we can monitor everything that needs to be monitored, I think we'd stand a much better chance.
Thanks. That's interesting. I mean, I just wanted to pick out on what you said. It seems to me that you'll probably be quite in favor of transparency in the financial stability assessment process. I mean, I'm asking this in the context of transparency in monetary policy, where we have come a long way in that regard and probably acquired a better understanding of how monetary issues and considerations can be conveyed to the market. In financial stability, I guess for a great part of central banks who are involved in this process, the learning curve, they're still on that learning curve, because to what extent do you ex ante identify vulnerabilities or risks that the financial committee might be concerned about, and what sort of dynamics does that communication imbue to financial market participants? Any thoughts on that?
Yeah, I think there's two parts to this. You're emphasizing the transparency, and I think that's very important, but with it has to go accountability. I think the minute that you empower a financial stability committee and give it tools to do things, they immediately shift to feeling like, okay, if something goes wrong, I'm going to get blamed for it. And therefore, I need to explain why I'm doing something, or if I'm not doing something, why I'm doing it. So I think you'll almost immediately get the transparency if you create an accountability framework. And for accountability to work, you have to actually have the tools to do what you're being asked to do. I mean, I think, again, I think the U.S. is in a very bad place because the FSOC really doesn't have almost any macroprudential tools. And so the public and Congress think they solved this problem after the GFC by setting up the FSOC, and yet you have countless speeches by people involved in the process. I mean, Bill Dudley, when he was president of the New York Fed, Stan Fisher, when he was vice chair of the Fed, both gave speeches saying, we have no tools. Don't keep telling us solve the financial stability problems with macroprudential tools. There are none. And so when you don't have tools, you can't have accountability. And if you don't have accountability, you're not going to get action. So I think transparency is very important, but I think you'll get that as a byproduct if you create accountability and you give the stability committees enough instruments to actually make a difference.
Indeed, thanks very much. I think we might be able to fit in one more quick question, if it's possible. This time around, if I could, changing the perspective a little and looking at emerging market space. So let's think about the potential capital flows as manifesting or carrying the risk that might emerge or leak out from Vegas. I guess my question would be, what are your views about the most important stuff that emerging markets ought to be investing in attempting to secure their own financial stability rather than just be passive sort of recipients of unintended spillovers?
Yeah, it's a very, very hard question. But what to do about this hot money that comes in and then runs away exactly when you don't want it to? I mean, a couple of things. First of all, you have to have your institutions be well capitalized. I think probably the best thing that we've done since the global financial crisis in the regulatory space is to learn how to do stress tests. And I think if I was sitting on a financial stability committee in one of these emerging market contexts, I would be running stress tests regularly that says, suppose the tide goes out and you're going to lose this funding very, very quickly. What's your contingency plan? And how is our financial system going to absorb this? And are we going to amplify it and make it worse? Or is there something that we can do? I mean, they can, the banks, if you force them to actually go through that exercise, would presumably have a plan. The interesting thing would be to see when you add it all up, are they all the plans of the banks internally consistent, or is everybody going to do the same thing and make things much worse? So I think I would begin with the stress testing framework and trying to make sure that the plans of the banks, and one good thing about the emerging markets is mostly this stuff is going to go through the banking system. So we're not going to have the shadow banking problem where things are happening and we can't see them. It's probably going to be the case the money's going to come in through the banks and go out. And then the question will be, can the banks continue to support the economy, or are they going to be scrambling to recover the funding in some way that forces them to cut off lending? But I think that would be my anchor, would be a routine stress test. And I would make the stress test counter-cyclical in the sense that as things get frothier and markets are more and more sanguine, I'd make the stress test more and more brutal, so that when it does reverse, you're going to have enough resilience to meet the problem.
Indeed, robust counter-cyclical stress testing. Unfortunately, time is sort of catching up on us, so I will need to draw this to a close. But I did want to thank you very much indeed for your insights, Professor Kashyap, and your time that you've expended on this lecture. I did want to point out that your research and policy work into strengthening the very foundations of financial stability comes together in keeping countries on a path of continued engagement with the international financial markets, and that, I think, core message and core commitment on your part is surely valued and appreciated. Thanks very much indeed.
Thank you.
This brings us to the end of the opening session for today. So I want to thank again all our speakers and to also invite you to be engaged in the rest of the sessions over the next few days. So thanks also for the audience for being with us this evening. Thank you.